It is my pleasure today to introduce Moe Russell. Moe was one of the co-founders of Russell Consulting Group in 1998. He provides risk management services throughout the United States and Canada, and he just brings a wealth of hands-on farming, financial, and marketing experience. Moe, welcome, and we will turn the program over to you.
Thank you very much, Leanne. It's a pleasure to be here, and welcome to all the participants. We're going to talk about several issues today in managing risk in the environment we're in, which is certainly volatile. And so let's get started. And we'll have at the end questions, so if you have questions, just type them in. There are tremendous opportunities in production agriculture ahead. First of all, worldwide there's increasing demand. I've heard different numbers. I've heard between 800 million and 2 billion people throughout the world. In the next decade, we'll move from poverty, which is about $400 income per year, to middle income, which is approximately $4,000 income a year. And I've met a lot of those people. And in almost all cases, when they get a taste of two things, meat and alcohol, they like them both. And it takes grain to make both. And so I think there's a great future in your business, and for those of you involved in the animal protein business, there's an equally great future in that. So we have many more middle-class consumers throughout America. Plus, throughout the world, America has always developed more entrepreneurs than any other country in the world. However, there's an increasing number of entrepreneurs being developed in different countries throughout the world. Chile is one. You know, the feat of getting those miners out of that trap mine was not coincidence. Chile has just done a tremendous job of ingenuity. Israel, the same case. And Iraq. Yes, Iraq. Iraq is sitting on a wealth of natural resources, and the Iraqi people have ingenuity, innovation, and appetite, and now they have freedom. So throughout the world there's tremendous opportunities, but here in the heartland of America, even greater opportunities. And I feel strongly that new fortunes will be made in the heartland. The reason is the increasing demand. Here are three charts. The one on the left is the billion of people since 1968. I started college in 1967, so this has happened from under 4 billion people just since I've been in my career to just under 7 billion people. Look at the center chart, the million tons of meat consumption, and look at the right chart, billion tons of grain consumption throughout the world. Plus, what's left over in the grain bin at the end of the year has been getting smaller since 2001 on a long-term trend line basis. So I think there's tremendous opportunity in your business. However, it's going to be volatile in years ahead, and we'll talk more about that. Here's oftentimes people ask me, Mo, what's going to happen to corn and bean prices? First of all, I don't know. If I did, I wouldn't be here. And I'm going to review some techniques and tools that we use in helping manage risk. But I would like to share several grain charts here. One is the bottom one. This is the corn chart for 1996, the last time we had carryover levels at the current point in corn and soybeans. The blue chart up here is 2008. Also the last year we had low carryovers. And so far the black line has been this year, 2012. Look at the similarity between 2011 and 1996. The market went up, it set back, it went up again, it set back, and that's exactly what happened. Greater than 95% correlation in the moves. What will happen this summer? If we have any production scares at all, and generally it's always too hot, too dry, too cold, too wet, and when we have those conditions this summer, I would really encourage you to take advantage of these grain prices. Our customers are currently 40% sold on corn and soybeans for 2011 and have another 20% of put options protecting it because anything can happen and these prices could vanish. So good risk management dictates that you take a profit when it presents itself, and I'll talk more about that later. However, your greatest asset is not the line of equipment you have, it's not the corn and soybeans in the bin, and it's not your land. Your greatest asset is your entrepreneurial skills. Winston Churchill once said that the empires of the future are the empires of the mind. And one thing I see real exciting opportunities are multi-generational families, and probably 2/3 or 3/4 of our clients are involved in multi-generational opportunities, and I'm really excited about that. In some cases, 3 generations. I'm also going to discuss today the mapping of the DNA of successful farmers. One thing real interesting happened to me a year ago on the speaking tour. Oftentimes after I'd make my comments, farmers would come up to me and the first group would, in a shy way, say, "Mo, I'm excited about the opportunities that are presented to us, and in some cases opportunities come our way more quickly than what we anticipate or can handle." And that's neat. But in many situations, a second group would come up to me and say, "Mo, I want to grow, but I just can't find any ground." And it seems like the gap was getting wider as I moved on. And so what I did was last summer I put together a list of mapping the DNA of successful farmers, and I'll share that with you. Lastly, those of you who have heard me speak before, I feel strongly that there's more money to be made in farming than any other industry, and I'll review that later also. Shifting gears, profitability in your business is not a function of type of operation, size of operation, or location. This is return on assets in the middle column, return on equity in the right-hand column of selected clients of ours, names removed, for 10, here's 12 years, 11 years, 34 years, 11 years, 6 years. Look at all of them double-digit return on equity. And the operations vary in size from 860 acres to 12,000 acres. So profitability is not a function of size of operation. I will share with you later what profitability is a function of that we've determined. So if you can start with a $500,000 net worth and grow it at about the industry average, you're going to double your money in 10 years. It's the rule of 72. However, if you can grow your net worth at the rate we see our clients growing it, which is right at 17%, look at the difference in the net worth. The difference between $983,000 and $2.4 million buys farms. It puts up machine sheds, it builds homes, it puts kids through college. And the gap will continue to get wider by the day. And so that's why managing risk in a volatile environment is important, and I'll share with you some tips how to do it later. First of all, though, I'd like to take a look back at history, because I think in looking at the crystal ball in the years ahead, we can learn a lot from looking at history and what has happened in the past. This is a chart that has net farm income essentially for the last almost 100 years. And that net farm income is in the maroon lines. However, what we did is we readjusted those net farm income for the last 100 years in 1982 constant dollars. And the average was about $42 billion. Then draw an imaginary line with me about $20 billion above that, a little over $60 billion, and then draw an imaginary line with me about $20 billion below that at $20 billion, and let's look at the outliers. Perhaps we can learn something from this study. First of all, there's only 3 times in the last 100 years when times really got good. 1917 and 18, a period of 7 years during the 40s, which I believe was an aberration, and 1973. My father always said the Depression was the worst time in the last 100 years. Not so. Sorry, Dad. 1983 was the toughest year in the last 100 years. And so those of you that were farming in 1983, take pride in the fact and tell your kids and grandkids that you survived the worst time in the last 100 years. Lastly, what I learned from this study was that good times don't last. Look at what happened in 1918, 1919, 1920, 1921, from 50% above average to 50% below average net farm income. Look what happened from 1973, 74, 75, and then the whole period of the 80s that were really tough. So several things we can learn from that I'll discuss in future slides. But look at the other industries. Every industry in production agriculture is cyclical. Look at the hog industry. Losses below the line, profits above the line. Look at cattle feeding returns, even more ugly. Look at the egg, turkey, and chicken industry. No industry, including growing corn and soybeans, is immune from cycles. And as long as we have the two basic human emotions of fear and greed, and last time I checked, they were still intact, we're going to have cycles. So the challenge is, how do you manage around cycles? This is an interesting, I believe you can see the numbers on the screen. Look what happened in just a 2-year period. Corn on an inflation-adjusted basis in 1930 was higher than it is today. It was $7.50 a bushel. 2 years later, in 1932, it was an equivalent of $2.02 a bushel. And on November 28th, it was $5.75. So things can change very quickly, and bulletproofing your balance sheet, which we're going to talk about later, is the best way to make it through those cycles. So in conclusion, cycles have been around for the last 100 years. I feel confident that they'll continue to be around, and will always continue due to greed and fear. So what do? The strategy I recommend is bulletproof your balance sheet during good times. And if you do that, then when your industry cycles, you can catapult ahead of your competition during those difficult times. Conversely, if you get greedy during good times, you will likely be on your knees during the bad times and not be in a position to take advantage of opportunities that present themselves. I don't know why I just figured this out this winter. I don't know why it took me 40 years to figure this out, but I thought back about farm families I knew during the late 70s and early 80s that it didn't look like they were doing much as far as expanding. What they were doing was they were bulletproofing their balance sheet. Then when we came to the difficult times of the mid-80s, they were buying farms, trading equipment, and just catapulted ahead of their competition. So that's the key. One of the keys in managing risk in volatile time. How do you bulletproof your balance sheet? First of all, let's talk about working capital. Working capital is the first shock absorber to get you through financial bumps in the road. And so that's why I list it first. How much is enough working capital? Now keep in mind, working capital is the difference between your current assets, which is your grain on hand, livestock that will be marketed in 12 months, prepaid expenses, and accounts receivable. Add those up and subtract your current liabilities, which is your operating loan at the bank, accounts payable, the amount of intermediate and long-term debt, principal and interest that needs to be made in the next 12 months. The dollar amount of that difference between current assets and current liabilities is your working capital. And I recommend 50% of annual revenue. So if your farming operation generates $1 million worth of gross income a year, you should have $500,000 worth of working capital. If you get there, you will have bulletproofed your balance sheet in regards to working capital. Next level to bulletproof your balance sheet is overall equity. I recommend that you keep it above 60% overall equity, and don't leave your land in at what you paid for it. Put your land in at about 3/4 of what you think it'll sell for today. The reason I use that guideline is it may not be worth what we think it is. Secondly, you'll have some selling cost, and third, you could likely have capital gains tax to pay. Next, way to bulletproof your balance sheet is try to keep fixed costs low. Last week I was in Kentucky visiting a client, and I was stranded in the Louisville airport, and I met the senior vice president of Daimler in Stuttgart, Germany. And I said, what's the biggest thing you worry about in your business, or do you try to manage on an ongoing basis? And he said, management of cycles. I thought that was interesting. Really relates to what we're just talking about today. Secondly, he said, we work very diligently at variabilizing fixed costs. So how do you variabilize fixed cost? First of all, there are many ways to do it. One is leasing equipment as opposed to owning it. One is leasing land as opposed to owning it. But having a mix is still healthy. But look for ways to variabilize your fixed cost. If you do that, when you go through a cycle, your costs have an opportunity to drop and your revenue is maintained. If you have many costs that are fixed, that we do in production agriculture, land, equipment, machinery, vehicles, when revenue drops, all your costs don't drop, and then your margins deteriorate. So that's a lesson that I think we can learn from others in production agriculture. Lastly, take a profit when it presents itself and it meets your goals. That we can't figure out what's going to happen to grain prices, but having a profit goal in mind and taking advantage of those opportunities when they present themselves is the best way to manage risk. I'd like to comment just briefly on land values. I did a study this summer, or last summer, that pertained to land values. I looked at 50-year periods starting from when Story County, Iowa was settled in 1846. It's when the data started being kept on land values. In that 50-year period, from 1850 to 1900, land values rose on an average of 4% annual increase. However, there were 4 periods of time when depression and low prices and foreclosures hit production agriculture. And in each of those 4 areas, land prices dropped in excess of double digits, and in some cases 50%. I thought that was interesting. The next 50-year period, there were only 2 periods where depression periods, 1921 to 25, which you observed on that historical net farm income chart, and of course the depression years of the mid-30s. However, the average annual increase was still 3.29%, very close to the 4% the previous year. And from 1950 to 2000, the average appreciation was 4.38%. So, and there was only 1 period of double-digit drop in land prices. That was 1982 to 87. Since then, things have really changed. Last 9 years, we've had 10% average annual appreciation in land prices, and in 2010, 15.9, and I believe in the last 12 months it's been 22%. The entire 160-year period, though, is 4.2% average annual appreciation. And when I work with clients and they ask myself or my associates, hey, can I afford to buy this farm? We do a net present value and internal rate of return analysis, and I plug in anticipated inflation of 4.2%. To me, a 160-year trend's a pretty good trend, and we've always had over those 50-year periods that kind of appreciation in real estate, and I think we will continue to have that. Switching gears, we've observed some overall risk management trends I'd like to briefly talk about. One is the attitude, and I list attitude first. Skills, knowledge, and profit gap among producers getting farther apart by the day. Secondly, we are entering a whole new wave of consolidation in production agriculture, particularly grain production. You know, in agriculture, we had the consolidation in the chicken industry in the 60s, the cattle industry in the 70s, the swine industry in the 80s and 90s. the dairy industry in the 2000s, and in the next decade we're going to see huge consolidation in corn and soybean production in the Midwest. And the reasons are listed there. First of all, there's no safety net left in the government farm programs anymore. Our cost of production is way above loan rate. The only safety net is crop insurance, and this year it provides a great safety net. That's not the case in all years. Secondly, we're going to have tremendous volatility. Thirdly, technology. The new technology in GPS, auto steer, variable rate application of seed chemicals and fertilizer, individual row clutch shutoffs, all this technology, ladies and gentlemen, it works. But you don't have to use any of it. You just have to compete with those that do. And fourth, the demographics. I anticipate that 70 to 80% of all the land in the Midwest will come up for sale in the next 15 to 20 years, and so there will be tremendous opportunities in production agriculture. Risk management observations. First of all, good times don't last. We've talked about that. We'll have significantly increased volatility and risk. And the last bullet I'd like to talk a little briefly about is everyone's downloading risk to you. You're at the end of the risk food chain, so to speak. And a story that I've shared before is we have a client that has a large farming operation, but also has an anhydrous ammonia business. And in the fall of 2006, one of his suppliers of ammonia asked him how much ammonia they're going to need, and he said, "I'm not sure. Depends how wet it'll be." And their response was, "You determine what you need, and then you prepay us for it, then we'll manufacture it, and if you don't use it by December 23rd, there will be substantial penalties for storage." So that's just an example of how everyone is downloading risk to you, the farmer. So managing that risk is a challenge. I would recommend that you develop contingency plans in your 2011 and beyond budgets and take out government payments. I think you'll still have them, hope you will, but managing a business based upon government subsidies is not sound, never has been in my opinion. And look and do some stress testing of your P&L and determine what it'd look like without government payments. Next bullet, look for opportunities to partner with input suppliers. This is totally opposite of the way we in production agriculture oftentimes manage our business. In many cases, we figuratively put a gun to the head of our input suppliers and say, "Give me the lowest price or I walk." And I think there are opportunities, tremendous opportunities, to look for chances to partner with input suppliers. I think if you do that, there's an opportunity for you to save 5 to 10% on your costs, and there's an opportunity for the input supplier to increase their revenues on both sides of the desk. Next bullet, recommendations for managing risk is seek, hire, train, and retain top people. Many of the top guns in production agriculture that I talk to, they are so good that they can get all the land they need, they can get all the equipment they need, and they can get all the money they need. However, getting the right people in the right place at the right time with the right set of skills and doing the right thing is increasingly difficult. A risk management tip I have for you is look for opportunities so that your employees have DITH means a dog in the hunt, and SITG means skin in the game. One way to do that is look at contract labor possibilities. We have several clients that have done that, and two things happen. First of all, you feel less like you're trying to push a log chain in managing people, and secondly, you will attract an entrepreneurial type of employee who's essentially running their own business. And so in not all cases can you do that, but where you can, I would really encourage that you do that. Next, I would encourage you to get green and stay green so that you can grow green. And I'm not referring to a particular color of equipment here. I'm referring to environmental plans and practices on your farming operation. Very, very important. The next bullet is have a public relations plan. This is what I teach down at TPAP, Texas A&M, every January. And you know, traditionally we used to have what I call the John Wayne attitude in production agriculture. We had the attitude that it's our farm and we're going to do what we want, when we want, and how we want. And those days are over. We all live in glass houses, and having a public relations plan, I and my family and my brothers are living proof that it pays and it adds to your bottom line in developing and working a public relations plan. We've done that with our swine production facilities, and it's really paid off. And last bullet, no pun intended, bulletproof your balance sheet by using the guidelines I previously discussed. Next, have a plan. It's difficult to determine what corn and soybean prices are going to do, and very, very few people can hit a home run. Making base hits is the way to do it. And I'd like to exit out of this and bring up a spreadsheet that shows how you can use just a moment. I think I will. Let's see. I don't think I have that brought up, that spreadsheet. Well, I'll just talk through it. That's a word. What you do, you can determine the gross dollars per acre you need to meet all your financial objectives. And the way to do that is, first of all, take all the term debt payments you have to make in the next 12 months. So these are all the payments on your term debt, which is real estate, facilities, equipment, and vehicles. Then add all, and this is principal and interest. Then add all projected operating expenses: seed, fertilizer, chemical, crop insurance, fuel, utilities. All those expenses, just lump them into one, and add that too. The next expense is add your living costs or operator draw in your operation. Fourth cost is add depreciation. And what I suggest is you add economic depreciation instead of your depreciation off your tax return. And lastly, add profit. Profit, we feel strongly, is a cost of doing business. Profit is necessary to capitalize your growth and stay in business. How much profit is enough? We used to, 10 years ago, look at $50 per acre. Today we use $150, in excess of $100 per acre, and in some cases $150 per acre. This year I've seen plans that are in excess, somewhere north of $200 per acre. So, but the bottom line is it's very important that profit be viewed as a cost. There's not a single cost you've got that's not included in one of those 5 listed there. Cash and non-cash, they're all included. So you then add all 5 up, and that is the gross dollars per acre you need for your operation. And here's the spreadsheet that shows that. This is an example of all 5 of those costs, total of $1,000,004. Then we put in acres, yields, a realistic price per unit, any other income, and then I tweak profit upwards and downwards so that total profit, or that so total expenses equals total revenue. And then yield times price, 181 times 440 in this case, is gross hours per acre. Every combination of that $796 is on this blue line. This is one of the most useful marketing tools I've seen used. Let's pull up the soybean one. So what you do is throughout the year you keep one eye on yield, one eye on price, and if at any point in time the price you can get today is at or above your blue line, you know your blue line includes all your payments, all your projected operating expenses, your living cost, your depreciation, and in this case $146 an acre profit. You can go ahead and make scale in sales. I would suggest you begin with 5, 10, 20% sales rather than getting carried away, and so then you also use the concept of dollar cost averaging. So you have 2 gross dollars per acre, one for your corn, one for your soybeans. And working throughout the year to achieve those gross dollars per acre is an objective. Doing that, having a plan, I will guarantee you makes farming easier and more fun, and it reduces stress. And you don't have to worry about what your neighbors are selling their grain for. They probably aren't telling you the truth anyway. So you can worry less about the competition. And since we just had the NCAA tournament last night, it's probably fitting that I use this example, but John Wooden, the legendary basketball coach at UCLA, won 10 NCAA championships. During his entire coaching career, he never had an opposing team scouted. His team manager kiddingly one day said before a game we'd have to go out and buy a program to see who we were playing. And I think that's a lesson to be learned. If you have a plan in the gross dollars per acre you need in your farming operation and you work that plan, I'll guarantee you farming will be easier and more fun, and you'll make more money with less stress. Here is the mapping of the DNA of successful farmers that I talked about, and I'd like to go through that. First of all, they have a positive attitude. Secondly, they have interpersonal skills that are above average. I'd like to share a story with you. Last March 22nd, I spoke in Amarillo, Texas for John Deere and High Plains Journal, and after my comments a gentleman came up to me and he said, Mo, we're just having a ball farming. I got 2 sons that are home from college, and we have opportunities presented to us sometimes more quickly than we can handle them. And so my antenna went up and I figured, ooh, this is a gentleman in Group 1. I'm going to get to know him a little better. And he shared a story with me. He said, Mo, you wouldn't believe it. We've just had an opportunity to rent 50 sections of grassland. And so I was talking to him about that, and he went on with the story, and he said the owner of that land said to him, he said, I suppose if you're going to rent my land, you're going to want a 3 or a 5-year lease. And Charles is his name. His response amazed me. He said, no, let's go a year. He said, I'm confident I can make you happy after a year, and I'd much rather have you happy after a year than mad at me for 3 or 5. I said to myself, huh, people with interpersonal skills like that get what they want. On the other end of the spectrum, last July I received a call from a gentleman in Fremont, Nebraska, and he said, Mo, what's land rent for around this part of Nebraska? And I said, I don't know, sir. I don't have a clue. Why do you ask? He said, well, I've got this landlady, and I've been renting her farm for the last 5 years, and she said next year's rent had better start with a 3 in front of it. And I said, wow, that kind of stings. I said, what's land renting for around the farm you're renting from her? And he said, oh, 200, 205, 210 an acre. I said, what are you paying? There was a long pause. He said, 135. I said, you know, if you abuse interpersonal relationships, you get what you deserve, not what you want. And I said, had you offered that lady something more than 135, like 185 the last couple of years, and I think you could have afforded it, she'd probably be beating down your door wanting you to re-rent that farm from her. So interpersonal skills are really a key chromosome in the DNA of successful farmers. They see the big picture. They work on what's urgent and important as opposed to what's not urgent and important, or urgent and unimportant, or not urgent and not important. They do planning, and it can be as simple as developing the gross dollars per acre I just walked through with you. They have a tremendous thirst for knowledge, and they understand that to grow and continue to grow their operation and their entrepreneurial skills, they need to continually learn. They network with other top producers throughout America from other states and even other countries. And lastly, they view problems and challenges as opportunities. Along those lines, I once heard, it was a 60-minute story where Morley Sather was interviewing Captain Grace Hopper of the United States Navy, and she reached the highest ranks at that time of any woman in the United States Navy. And I remember her saying that every morning she got up, she wanted problems and challenges throughout the day. And my experience is people that view problems and challenges as opportunities are more successful. So hopefully that is a helpful list of the chromosomes involved in successful farmers. Lastly, I would like to review a multi-generational model that Chris Barron from Raleigh, Iowa developed. And essentially, this is a multi-generational farming operation, 1, 2 generations at a minimum, and a senior generation that is around almost every day, not actively farming, but very interesting operation. But what they did was they are utilizing their expanded line of equipment and bringing in neighbors to that in many cases can get rid of their line equipment and farm with brand new equipment and have much more success. And what this their neighbor did was he essentially traded his entire line of equipment for 2 items, a planter and a field cultivator, and then leased them back to Carson Barron Farms. So essentially he had a farm sale, and he entered into a written agreement that in the years ahead, when he does discontinue his farming operation, he will rent the farm to Carson Barron Farms. So he's still farming it. He's just paying Carson Barron Farms to farm it. And so as far as FSA is concerned, he's still an owner-operator, as indicated in the bottom there. But tremendous opportunities to network together, and I'm not going to go through it, but they anticipate a potential $84 per acre enhancement by working together. So I think it's an example of how multi-generational farming operations can grow and improve their bottom line effectiveness. But what's important, and particularly in working together, is there must be trust, shared goals, and common vision. Otherwise, it's not going to work. I mentioned earlier that production agriculture in North America is a great business. What I do is every year I look at the Fortune 500 companies from the Fortune magazine, late April, early May, so it'll be coming out in the next 30 days here. The average return on equity in 2009 of the Fortune 500 companies was 10.5%. The average of our client base was 14% last year and 18% the year before. These numbers have been similar every year for the last 6 years. So I rest my case. I maintain there's more money to be made in production agriculture than any other industry. However, it's a changing environment, and we need to, first of all, timing is important. Did you realize that Walmart, Kmart, and Target all started in business in 1962? Let's just take Kmart and Walmart. Kmart's emerging from bankruptcy, and Walmart's the largest retailer on the planet. Same industry, started the same year, same inflation rate, same labor pool, same interest rates. However, slightly different plans and strategies have produced amazingly different results. And also look at Blockbuster versus Netflix business. I remember it must have been about 15 years ago. I was living in Omaha, Nebraska, and someone indicated that had I bought $1,000 worth of Blockbuster video stock at its inception, it would have been worth $1 million at one time. In the third week of November of last year, Blockbuster Video declared bankruptcy, and Netflix just ate their lunch. And I think we can learn something from that in production agriculture, that we have to use new technology, we have to manage our margins, and if we do that and manage risk in a volatile environment, we can be extremely successful. I would like to shift gears and talk about several leverage points for maximizing profit and benchmarking your operation with the best. As I indicated in one of the first 2 slides I shared with you, profitability in production agriculture is not a function of size of operation or type of operational location. Well, if it's not a function of those, what is it a function of? Profitability. Here's the list. There are 4 major leverage points to the high profit farms, the top guns in your industry. First of all, they do a better job marketing their agricultural products. And if you are not consistently getting in the top third of the market with your corn and soybeans, I would encourage you to hook up with somebody that can get you there. The second major leverage point is equipment cost per acre. This is the equipment cost per acre just in our portfolio. And we work with some of the best farmers in North America. The third leverage point is labor cost per acre. Look at the range in labor cost per acre, from $19 to $127 per acre. Those top 3 are major leverage points for bottom line profitability. The fourth one is agronomic management, and this is seed selection, tillage, drainage, compaction, irrigation, timely planting, weed control, timely harvest. We don't get in that sandbox and working with our clients and don't ever intend to, but we've identified it as a huge leverage point. The fifth opportunity, and it's really the smallest rabbit to chase, is reducing input costs. And when you stop and think about it, what you pay for seed and fertilizer and chemicals probably isn't a whole lot different than what your neighbor does. But the top 4 leverage points are the big rabbits to chase, and if you can leverage those, in my opinion, you can add a minimum of $100 per acre extra profit to your bottom line. You cannot manage what you cannot see and or visualize. So figuring where you're at in these numbers is the first place to managing risk in a volatile environment. Lastly, and then we'll open it up for questions, we benchmark this data for our clients. Kind of stumbled into this. About 6-8 years ago, we have our clients come in July, third week of July, for an annual summer conference, and one of our clients looked around the room and said, "My goodness, Mo, you've got some of the best farmers in America here. Did you ever think about benchmarking our numbers?" And I said, "No, but we'll do that." And we discovered, ladies and gentlemen, we were sitting on acres of diamonds, because no one else has this type of data, especially as extensive as what's outlined here. And secondly, it involves those major leverage points to bottom line profitability. So this column right here is the 2009 average machinery cost per acre. Below that is the average labor cost per acre at $33 and some change. And then we add the two. Because there's two ways you can accomplish that objective on your farm. You can do it with more equipment, less labor, or you can do it with more labor and less equipment. But at the end of the day, it's the combination of the two that impacts your bottom line. The right-hand column is the data for 2010. Notice how it significantly increased. And that's by design. We encouraged our clients in the past year to two that if you're going to continue in the farming game, you might as well upgrade your equipment for the four following reasons. First of all, the new technology works. Secondly, I don't think the iron's going to get any less expensive. Thirdly, we have interest rates at 50-year lows if you need to finance it. And fourth, you have the Section 179 depreciation to offset high levels of income if you need it. Down below is the average return on assets and return on equity for the same years. The right-hand column is 2010. The middle column is 2009. So tremendous potential, and as I indicated, it's difficult to manage what you cannot see and or visualize, so knowing where your numbers are is the first step. Once again, size does not enter in as a factor. These are actual cases of clients of ours, the acres on the left, machinery cost and labor cost per acre in the two middle columns, and the combined machinery and labor cost per acre. Notice small, medium, and large. I don't know if that fits your definition, but that kind of fits mine, small, medium, and large. All of them at or around $60 to $90, $100 machinery cost per acre. And so it can be done, and it's not a function of size or type of operation. Lastly, then we'll open it up to questions. There are four hats you wear every day. First of all, you're the plant and production manager. You have to get the crop planted, weed control, sprayed, harvested. But there are three other hats you wear. First of all, you're the financial manager. Secondly, you're the marketing manager. And thirdly, you're the human resource manager. And I've very seldom observed people with unique skills in each of these four areas. In fact, I cannot think of a single one. So what I would suggest you do is determine what you like doing and are good at. Spend more time doing that. And know what you don't know and what you don't like doing or aren't good at, and hire it done. And I'll guarantee you, if you do that, farming will be easier and more fun. Leanne, do we have any questions?
Yes, yes, Mo, we have one question, and I would encourage anyone else who might have questions to type it down in that section below. The first question, Pat asks, you mentioned agronomics as one of the rabbits to chase. Any advice on where to improve profitability related to agronomics based on experiences with your customers?
Okay, thank you, Leon. Excellent question, Pat. First of all, timely planting and timely harvest is a big factor, and this really varies from where you're at. We maintain, even though we do concentrate on machinery cost per acre, it can be too low. And the reason I say that is you need enough planter power in this part of the Corn Belt to get your crop planted in 10 working days, corn and soybeans. Harvesting equipment, you need enough harvesting equipment to get it harvested in about 30 days here in Iowa. Now that varies tremendously throughout America. If you're in Fargo, North Dakota, you probably have about a 10 to 14 day window. Here in Iowa, you probably have a 29 to 30 day window, and if you're farming in Tennessee or Kentucky, you probably have a 44 to 45 day window. So I would first of all use those two guidelines, planning and harvesting timeliness, seed genetic selection. My experience is the new seed genetics work. In fact, the spreadsheet I used earlier, oftentimes I have clients call and say, Mo, will this new genetics pay? I say, well, let's just look at my model. Let's put the extra cost of the seed in, expenses. You tell me what you think it'll do to yield, and then I hit enter, and if it does not increase return on assets and return on equity down here in the bottom part of the spreadsheet, why do it? And parenthetically, in about 95 or more % of the cases, that genetic technology works. Other questions, Leanne?
I would invite anyone else to type questions down in that question section. While we wait just a minute, I'm going to see, Mo, if I can change the screen to mine so that I can give your contact information, if that's okay, if people have questions for you. Okay, I want to just thank Mo for this wealth of information that he has shared. I feel like I hear a lot of farmers talking, and you just hit on things that they're talking about. So we really appreciate this. It's very practical and useful information, lots of good tips. If anyone who's listening would like to hear some of this again, or if there's someone you know that you think would benefit from this, we will post a recording of this presentation on our website, and I have that available on this screen. If you have questions for Mo, I have his email also on this slide, mrussell@netins.net. And we just would thank everyone for joining us today. And if you have suggestions for future webinars or other information that we can provide to you, we would certainly welcome your input. I have another question for you, Mo. Sharing equipment may be one way to reduce equipment costs. Do you have any advice on how to do this successfully?
Yes. One thing I mentioned in that, and I didn't have enough time to really go through that example of that Chris Barron has modeled, but one of the things that's really important in sharing equipment between operations is that the bottom of that one slide where I commented trust, shared goals, and common vision. If that's not present, all of the written operating agreements in the world won't keep you out of problems. For example, if the 1,000-acre operation that they're working with had the opinion that this is a great deal for him, but his corn needs to be planted first and harvested first, it is definitely not going to be a working relationship that's based on trust, shared vision, and common goals. So that's the first priority. If the concept you're looking at meets that acid test, go to step 2, and I would be encouraged that you'll make good progress. If that acid test does not prove positive, save your time and money, because most likely it's not going to work.
That's a good perspective. Any other questions? If not, I would thank you again for joining us, everyone, and thank you, Moe. And with that, we will close this session. And again, you can look for this on the website, and please look for future webinars. Thank you.